I'm super excited to be bringing this one to you. This is actually the first time that we've done a webinar on inheritances and intergenerational wealth, and we've been getting a ton of questions from people at the moment around intergenerational wealth. We've got this huge wealth transfer that's happening in Australia. Depending on how you measure it, it's like $3.5 trillion or something like that. So there's a bit of money sort of sitting on the table, and huge opportunity there, from a financial perspective as well, particularly with cost of living, property market. It doesn't seem to be getting any easier for people to be getting ahead. And so whether you're, passing on an inheritance to help future generations or potentially receiving an inheritance, again, there's a big opportunity there. So keen to get stuck in. Saw a couple of questions about recordings. Yes, the recording will be available. We're going to share that with you. That will go live on the Sharesight website in a little bit as well. And I saw we've got Prashant from Sharesight sitting there behind the scenes as well. So if anyone's got any questions about Sharesight stuff, you can pop that into the chat too. Just one for the lawyers. This is not financial advice. Please don't rush out and make any big decisions off the back of what we cover. If you're talking about 6 and 7 figure decisions, you're probably, it's probably a good idea to make sure you got your I's dotted and your T's crossed as well. And look, I just touched on it there, but a big shout out to our event partner for today in Sharesight. If I know that a lot of people that have registered have come through the guys over at Sharesight, but if you're not already familiar with them, basically one of the most powerful portfolio tracking softwares that allows you to see all of your investments in one place, and see performance, dividend tracking, tax reporting. Just bumped into Prashant at one of the awards nights because these guys are known for being the best in this space as well. So if you're not already familiar with them, definitely one to check out as well. Now, look, I put this in off the suggestion of someone that emailed me off the back of the last one that came to one of these webinars for the first time, but I tend not to like talking about myself too much, but just by way of a little bit of introduction, my name's Ben. I'm a founder and financial advisor at Pivot Wealth. We're a money management company. We help people to essentially invest smarter so that they can create a life that's not limited by money, where money isn't something that's holding you back from doing what it is that you want to do. And look, I think if you think about money success, it's not like, we help a lot of people with their money, and it's not like we're using some sort of financial black magic or anything like that. It's just about having a system that actually works. And, when it comes to inheritances and intergenerational wealth, there's a system around that as well. And that's exactly what I'm going to talk you through today. Now, when it comes to this, works for inheritances, but also just money more broadly as well, that there's basically 3 things that we focus on, the 3 areas that we've found that you absolutely need to get right if you want to nail it with your money. And that's structure, strategy, and solution. So structure is all about cutting and optimizing your tax, using smart leverage in the right way, having an automatic saving system that works for you. The right strategy is about maximizing the money that you have and balancing, having a good lifestyle today, but making sure that you're setting up the future that you want as well. And then solutions is all about the investments that you have to back up your strategy and your structure. And here you want to make sure you're making consistent, reliable progress and avoiding the chances of downsides and setbacks and those momentum killing mistakes. And look, I can tell you that when you get this stuff right, it absolutely works. And so I've got a few stories to share with you to show you what's possible. So these are a bunch of clients of ours. So Aaron and Eric, they through putting the right systems in place, they were able to buy their home about a year sooner than what they otherwise planned. And buying a home with a patch of grass, close to the Sydney CBD is not a simple thing to do. Put in bonds in place for future generations, getting some tax efficiencies. I'm going to talk about them in a little bit more detail as well. Some growth to support education fees and school fees. Part of intergenerational wealth is not just about inheritances, but providing that level of support. And for these guys, a big thing was optimizing their tax so that they could then crank more investment capacity, because we obviously pay a lot of tax in Australia. The more you can save, that's an extra dollar. Every dollar of tax saved is an extra dollar that you can save or invest and actually use to get ahead. Elise and Scott, they used automated savings to create some borrowing power. So they had a bit of leakage that was causing them a barrier to buying their first home, which they ended up getting years ahead of what they thought was possible. They had some smart debt structuring for tax efficiencies and create some investments for their future family income as well. Luke and Talia, these guys managed to crank their savings, but without having any too drastic lifestyle sacrifices. Importantly, and I think really important ingredient for anyone that wants to create intergenerational wealth is that they're building assets and income outside of the family home. Property is the great Australian dream in this country. But we've got a lot of people that are like paper rich, but they're actually a little bit poor because all of their wealth is tied up in a home. So for these guys, it was about building their investment income outside of just their home, kids' investment strategy, and risk management. For James, he was looking at investing in insurance payout and the proceeds from a property sale. He ended up using this system to rent vest and use rules-based system to save himself time and a bunch of friction. And the last one here for Kate is she was rebuilding her and her family's wealth after a relationship breakdown. She cleared a bunch of debt with some guardrails in place, purchased an investment property, and again used tax savings to build her investments faster. Now, the reason I put this here is to show you that this stuff works. Over the last 10 years, we've helped our clients build over $2 billion from following this sort of approach, and you guys can absolutely do this too. And a big warning here before we get into the kids investing intergenerational wealth stuff, that sometimes if you're thinking about intergenerational wealth, that means sorting yourself out first, making sure that your finances are good as a first step so that you can then do more of what you want to do for other generations and your family members in the future. And that sort of ties in with the different stages that people move through with their money. So one of the things that we've found over the years is that there is 5 fairly defined stages that people move through, from just getting started with their money all the way to what we call the impact stage, which is essentially that you've got enough money to live your ideal lifestyle without you ever having to work again. So everyone wants to get there, but no one really starts there. You start at the start. You've got to put those foundations in place. You've got to focus to, get your savings working, getting your investing happening. You've got to get into the property market. Then you've got to optimize, get some tax efficiencies, use smart debt to use your equity to be investing, accelerate, and then that leads through to the impact stage. And so that with the stuff that we cover today, keep in mind that not all of the things are going to be good things for you to do right now. In fact, I'll just share this next slide. So don't worry too much that you can't see the detail here, but what we've got is that basically at each of those different stages that I just mentioned, that there's a bunch of different activities that you want to do and actually complete before you move on to the next stage. Because it's really natural for people with their money that they're doing well in one or maybe a couple of areas. Maybe they're really good at saving and they've got okay with their property strategy, but they've not got any investments in place, or they haven't sorted out their super or whatever. Or maybe it's the other way around and they've got some investments, got some savings, but not in the property market yet or whatever. And basically you want to make sure that you tick each of these things off before you move on to the next stage as well. And so I'll share with you guys as well exactly how you can get this to do a bit of a diagnostic for yourself to see where you're at the end as well. Because really what stage you're in, where you're at with your money, dictates what makes the most amount of sense and what doesn't. And I've actually stole a couple of my examples, but investing for your kids is good, but if you've got a bunch of personal debt, then you're probably going to get a lot more bang for buck by clearing that first. Buying your own home is a good idea as well, but if you do it too early, then it can kill your cash flow and your ability to actually save and invest money as well. If you're using investment bonds, they're an awesome way to save tax, but if you do it too early, it can be a mistake because you're not going to leave the money there to actually capitalize on the tax advantages as well. And so the overarching message here is that doing the right move at the wrong time is the wrong move. Because a lot of people say that when it comes to money, it's like, oh, you should buy shares, or you should buy an investment property, you should buy your own home, and all of these things. And they talk in really absolute terms, but The reality is that all those things can be good or they can be not as good. Whether they are good or not good, it really depends on you, what stage you're at, where you're at, and what the next move is for you as well. So I just wanted you guys to keep that in mind as we're going through these sections. Don't feel like because I'm saying something is going to save tax or be a good idea, that it means that it's a good idea for you right now. Um, and I can see a few questions coming in, guys, and love those questions. Please do keep those coming in. I don't want to end up behind on my time, so I'll crack through this section and then I'm going to jump into a few questions, anything about tax or anything generally inheritance related as well. So look, I want to start by busting a really big myth, or maybe clarifying a bit of a myth in Australia that in Australia there is no inheritance tax. So that is a statement of fact that there is no pure inheritance tax in Australia. However, there is tax that applies based on you inheriting different types of assets. And so I'm going to step you through each of the different types of assets that you may inherit and the tax implications of those. But ultimately, it's only how much money you have after tax that really matters. And most people don't realize this until it's too late to actually do anything about it as well. Now, I know that appreciate that everyone's got different viewpoints around tax, and some people think it's really important. Some people get less excited by paying big tax bills. But for me, when I think about inheritances, I think that it's a pool of money that people are trying to pass down to future generations. And so for me, you want to try and pass on as much of that money as actually possible, which means that trying to optimize and reduce the tax on that as much as you can. Then, if the person that is inheriting the money get it and they decide that they want to make a donation to the ATO or the government or the charity that they want to support or whatever, then they can absolutely do that. But you make it a choice, not something that's forced on them as well. So I'll step through each of the different types of assets that you might inherit and how the tax works. The first one is a really simple one, inheriting cash. Simple and easy because there's no tax on cash inheritances. But you should be aware that any money that you have sitting in cash is going backwards because of the fact that interest income on bank accounts is taxed at marginal tax rates. And then that after tax return is impacted by inflation. So typically, even if you're earning, 5% on a savings account, you're getting about 3% after tax. And then you've got inflation running at 3%, meaning that at best your money is standing still. At worst, it might be going backwards, particularly if it's not sitting in one of the highest interest bearing accounts as well. And so one of the big mistakes with cash is people leaving it sit there for too long. Essentially, because they're not sure what to do or how to make it work, but don't realize that they feel the silent cost of all of the tax and in inflation side of things as well. Inheriting the family home is the next one. And so if you're inheriting a property that's been someone's primary residence full time, just like for your own home, there's no capital gains tax, or you get the own home capital gains tax exemption. You will inherit that property without any capital gains tax attached to it. And if you sell the property within 2 years, there's no capital gains tax, assuming that the property has been a primary residence for the entire time that it's been owned by the person that you're inheriting it from. But if it's not sold after that 2 year period, then capital gains start to accrue. And so they accrue based on the value of the property at the date of death. So if you inherit a property and at the date of death of the person that passes it on to you, the value of the property is $1 million, and then you sell it in 1 year and 11 months for $2 million, no capital gains tax because it's under that 2 year period. But if you sell it in 2 years and 1 month and you've got a significant gain, you'll pay 2 million less than $1 million value as a capital gain. Catch to that though is that if you move into the property, then it can become your principal place of residence. And even if you move out of that property, you can use what's called the 6-year rule to have that property nominated as your principal place of residence for up to 6 years, meaning that you wouldn't pay any capital gains tax if you sold it within that period. Then, even if you move into the property for a brief period, that resets the clock for the 6-year rule as well. Really powerful strategy when it comes to optimizing your tax position. The only thing that's worth noting there is that you can only have one principal place of residence. So if you've already got a principal place of residence, you've already got your own home, you would need to nominate the property that you're inheriting as your principal place of residence in order to get that capital gains tax exemption. Now, one sort of issue or mistake to look out for that we see with some people, they'll inherit a family home. If they're inheriting a home that's got a high, value, and the Australian property market's a little bit crazy depending on where you live. Where we're based in Sydney, the market can be a bit mental. People might have this huge asset that's worth quite a lot of money, but they want to move into it because they've got an emotional attachment. But then they've got no money or no capacity to be building up any other investments outside of that home as well. And so you just want to be, when it comes to your planning, be aware that that sometimes if you're inheriting a family home, there can be a huge opportunity to really set up your own financial security, but you need to take advantage of the opportunity, I suppose. Now, inheriting investments like shares or investment property, is a little bit different. In fact, comes with further tax implications because the assets are essentially are investments of the person that you're inheriting from. And so essentially, the first thing that you want to look at, if you're inheriting a share portfolio or a bunch of shares or an investment property, you want to look at whether those assets were purchased pre or post 1985. Now, I might just throw this out to the chat for a sec. Does anyone know why the September 1985 date is important? I'd love to know, because this was something that I was not familiar with at that point in time as well. Tell me. I can see some people here. Capital gains tax. That's right. Exactly. Yep. Mandy, Lee, Matt, and Doug, you guys have absolutely nailed it. Full gold stars there. That is when capital gains tax was introduced. And so if you've inherited a property that was purchased before September 1985, which is getting less and less common as more and more time goes on, but essentially that is a pre-CGT asset. And so what happens then is that the cost base of that asset will reset at the value at the date of death. So if someone bought a property for $47 in 1984, and then it's worth $2 million today, that basically that whole gain is capital gains tax free. And if you inherit it and it's worth $2 million, then that becomes your cost base for that property. If you sell it for $2 million, you sell it straight away, no capital gains. If you sell it in 10 years' time for $4 million, there'll be a $2 million capital gain, which is the difference between the sale price and value at the date of death. Now, for most assets that people inherit, these are the ones that are going to be purchased post September 1985, which is, after the introduction of capital gains tax. And what happens with those assets is that you're inheriting the cost base of the property. So if someone bought an investment property for $100,000 and that you've inherited and it's worth $1.1 million at the time you inherit it, that there's a $1 million capital gain that you would need to pay some tax on. And so can be really significant in terms of the tax. $1 million capital gain, you potentially, that gets a 50% discount. You got $500,000 of taxable income, $250,000 or thereabouts of tax. And that, considering the leverage versus tax on an investment property, is something really important. So I've got an example to share with you here. Basically, you inherit a $1 million property with $300,000 cost base and a $250,000 mortgage that's attached to it. Now, in this case, if you were to sell that property, there'd be a $700,000 capital gain, which, assuming that the asset had been held for longer than 12 months, means that you've got a gain of $350,000. Just roughly, I'm using the top marginal tax rate here, $175,000 in tax, a little bit of money to sell the property. You basically, if you sell your $1 million property, you're going to end up with about $550,000 in your bank account, which, don't get me wrong, 550 grand in your bank account, that's going to be very welcome any day of the week. However, if you look at the actual equity on this property, you can see that even though there's a bit of a mortgage on there, there's $750,000 of equity that's attached to the property, meaning that you could potentially borrow against that property to build a share portfolio or buy another investment property or buy another 2 or 3 investment properties, depending on your borrowing capacity. And in that case, you wouldn't need to pay any capital gains tax at all. You keep the property, you keep getting the future growth on the property, but you've massively multiplied the amount of money that you've got in your investment wealth. And so when it comes to inheriting investment properties and significant share portfolios as well, it's really what you do next that really makes the difference. And it's not always as obvious as it seems. And so I'll give you the overall tips in the end, but it's definitely an issue that's worth being aware of. Now, inheriting super, that can come with some really significant tax consequences. Basically, you can be taxed at up to 32% on the value of any super money that has been inherited, which is a pretty considerable chunk, particularly given that people build up their super for the course of their careers. That's supposed to be their retirement savings. They think that it's their. A lot of people don't understand the tax on super death benefits, but it is there. And yeah, as you can see from those numbers, it can be quite significant. Now, essentially, how the rules work with this is that if you pass away and you pass your super on to a dependent beneficiary, then there's no tax that applies on that transfer. A dependent beneficiary is essentially your partner or minor children, so children under the age of 18, or people that are financially dependent on you. So if you've got a family member, say, that has a disability, and that person is financially dependent on you, then that may be considered a dependent under the rules. Non-dependents include, the most common one that comes up is adult children. If you've got adult children, which, given life expectancies, people are in their 30s and 40s when their parents pass away, sometimes even older than that, that your adult children are not going to be considered dependents, not going to be considered financial dependents on you. And so that's when this death benefits tax kicks in. Now, the amount of tax that you pay is based on the components, what's called the components of your super fund. This labeling gets a little bit confusing, so please bear with me, and I'm happy to direct you to some more content if you want to dive deeper on it as well. In fact, we're just about to put something up on the Pivot Wealth blog that dives into this in quite a bit of detail. But essentially, there are three components that make up your super fund. There's what's called taxable taxed, taxable untaxed, and tax-free. Now, I get that I've said tax a lot of times there, but essentially tax-free money is money that you put into your super after tax. Think of a non-concessional super contribution, like an after-tax contribution that you put in from your bank account and you don't claim a tax deduction for. So for most people, that's a smaller part of their super money, if any of their super money. That part is received tax-free for either dependents or non-dependent beneficiaries, because it's essentially after-tax money that you put into your super. There's also this taxable untaxed element. This is less and less common these days, but it was quite common with like government benefit schemes, like the old defined benefit government super pensions. And that's the part that gets taxed at up to 30% plus Medicare levy, so essentially 32%. Then you've got your taxable tax, which for most people is the biggest part of their super, because it's made up of all of your compulsory employer super guarantee contributions, as well as any salary sacrifice contributions that you make. So contributions that you get, either salary sacrifice or personal tax deductible contributions. That component is taxed at 17%. So that means if you inherit $1 million from mum or dad's super fund, you're going to pay $170,000 in tax on that money, which is a pretty big whack of tax. And this is all avoidable and manageable with the right strategy. And so, again, this is a little bit complex, so I just want to talk you through this to show what's possible. But don't worry if if you're not getting full detail on this necessarily straight away. Now, you can make the money that's inside your super essentially the tax-free element. And how you can do that, it requires some planning and a really good understanding of the rules. And it's not a DIY strategy that I would suggest. It's something that you want to get good advice on. But essentially, if you withdraw money from your super fund when you can access your super, i.e. when you're older, and then you withdraw the money, you withdraw post age 60, there's no tax on those withdrawals typically. If you then put the money back into your super, it goes in as an after-tax contribution, which sits there in the tax-free element, meaning that if that money is in the future passed on to non-dependents, that there's no tax that applies on the money. Now, you can get quite a considerable amount of money into super under the after-tax contribution limits, or what's called the non-concessional contribution limits. That amount is $120,000 each financial year, but you can also bring forward up to 3 years of super contributions, so long as your super balance is below what's called the transfer balance cap, which is currently 1.9 million bucks. So, which is for sort of most people. Now, the 3-year rule allows you to bring forward 3 years worth of contributions into 1 year, meaning $360,000 can be contributed after tax into your fund in a single year. And so it is possible to contribute, say, because it's financial year based, you could contribute $120,000 on the 30th of June. You could contribute $360,000 on the 1st of July, and you basically got $480,000 of your super converted into tax-free money. Now, this is a great conversation to have with your folks if you think that they're wanting to leave you an inheritance, because a lot of people don't know about it. And for a lot of people, you ask if they want to pay $170,000 tax on their $1 million of super, they're going to say no. And so that can be managed with the right strategy. You typically would need to do it over a bunch of time. And as I said, it's probably not a DIY strategy, that you want to get some advice on that as well. It's also, there's one further limit that you can only make these contributions before the age of 75. And so there is a ticking clock on that as well. And so if you want to do this, it's something that you probably want to be starting earlier rather than later. Now, sort of bringing all of this stuff together, particularly around tax, that the key things that you need to do if you're considering giving or receiving an inheritance. Firstly, understand that most inheritances disappear within 3.5 years, which is a pretty scary statistic. And often it's not something that you want to have, not the reason that people are inheriting money. People might have a trip, they do a renovation on their house, and then all of a sudden the money is just gone, and it hasn't made a meaningful difference to their wealth or to the wealth of future generations as well. And so that's, I suppose, to set the scene. But when you want to make the most of an inheritance, the first thing that you want to understand is the tax position. What tax applies? What are the assets that you've got? And then look to minimize your ATO donation as much as possible. Then the next step is to put that money to maximum work when it comes to ideally generating you some income. So getting some income generating assets into place so that you can start the process of replacing your salary with investment income. And ideally, you want to have a plan before and perhaps even start the conversations earlier. This can be a good catalyst that, if you're wondering how to broach it with mum or dad, talk about the fact that you've come across some content, you understand that there can be some significant tax implications. Is that something that they've already sought advice on? And if not, were they aware, were they open to doing that? Because as I say, for most people leaving an inheritance, they don't want to leave a massive tax liability. They want that money to get into the hands of the people that they want it to as well. And so I'm going to switch gears a bit and talk about investing for intergenerational wealth. But I just want to touch on a couple of these questions. AY says, I want to help my daughter, and keep these questions coming through, guys. I want to help my daughter with deposit and miscellaneous cost to buy property for tax efficient purposes. Put the property under whose name? Joint names, my daughter's name or my name as a retiree. Well, look, AY, this is not advice, and we can't give you advice before jumping in, but I'm happy to talk through some of the considerations there as well. I've got this in there in a section on tax, but just to answer it directly, essentially, if you're helping your kids to purchase any sort of investment and you're doing it in their name, particularly if they're adult children, then all of the assets are in their name, and the future tax implications on those assets they own. If you own the property in your name, then it's essentially an investment that's in your name, and so perhaps if you pass it on then to your daughter in this case in the future, then she might be inheriting a tax obligation that comes with that as well. So that's probably one consideration. One thing I would say that for anyone that is considering helping their children financially is that having a formally documented loan agreement is generally quite a sensible idea. A formally documented loan agreement can be as simple as, I'm lending you $50,000 or $100,000 for your property deposit, and I can call on that loan at any point in time. Now, that might sound a little bit, aggressive if you're just trying to help your kids, but where that can come in really handy is if your kids have relationship breakdown in the future, because the loan exists, then that forms part of the overall property assets. Because we've seen, unfortunately, a number of times for people when they leave money for their kids, if you leave it to them directly, then it's just their assets, and then they have a relationship breakdown, and you can see like half of the gift or half of the inheritance money just disappearing with an exiting spouse, and that's generally not what people want as well. So having everything legally documented, typically quite a good idea. Um, Julie says, if the will includes gifts to charities, will the payments then be deductible against any CGT on shares sold when the estate sells any shares or property, or should they be left in a wishes letter instead? Look, it depends actually on how they're passed. It's a bit of an edge case there, Julie. But if you're passing the assets directly through your will, like a share portfolio, then you're essentially inheriting the cost base of those assets. If the assets are being sold, then they go into the proceeds of the estate and then get washed out in the tax that way as well. But if you're considering doing that for yourself, or you've got folks that are doing that, I would 100% be talking to a tax accountant to understand that as well, Julie. One here, rules around pre-1985 purchase of principal place of residence. Could you please clarify tax implications if one rents out a PPR for parents for only 6 years, if it is to pay for residential care, and then we sell it afterwards once they pass, is it CGT free? Look, again, this is not tax advice. I'm not a tax accountant, but if you've got a pre-1985 property, then that's a principal place of residence. That's a pre-CGT asset, meaning that there is no capital gains tax that applies. It doesn't matter if it gets converted to an investment property, from 1986 or from 1985 when it was purchased. It's essentially a pre-CGT asset, so there's no capital gains tax that applies. If you've got a post-CGT asset and you've got that move into a principal place of residence to pay for residential care, then I would assume that's covered. That would be covered under the 6-year rule. What I'm not sure about is if there are any further concessions for aged care, because that is a really common one as well, and I wouldn't be surprised if there was. So I hope that helps. Another one here. What about mixed families? For example, step husband, wife, and partner, as well as kids. Any ideas to ensure they all get what's intended, i.e., step partner doesn't run off with the money? That's a great question. Look, I think it's ensuring that it's clearly documented in your will, but also that you probably want to be leaving money directly to kids. Like if you're in a situation where you've got, and I'm actually going through the process of redoing my will at the moment. I was talking to our lawyer that's doing that, and they said that there was a situation where basically there was a relationship, a couple, and the guy and the lady's dad was really unwell. The guy basically stayed in the relationship with her, and there was clearly some BV stuff that was happening here, but basically waited until she got the inheritance. Then he just took off with half of the money, and so that's essentially all up for grab. Once you pass the money to a partner or leave it to a partner in your will, then those assets become theirs, and you can tell them that you want them to give it to your kids, but they're not going to be bound to do that because it's their decision essentially. So you can get around that by ensuring that you're leaving the assets directly to your kids, and then it's your kids' assets as well. And there's another question here about testamentary trust, and that's essentially the same sort of thing that you leave assets through testamentary trust is a trust that gets established as part of your will, and that trust can be used to then hold your assets and essentially bloodline them and provide you with a level of asset protection as well. Will the super still incur super tax? Generally, the answer is yes on that one as well, because super is not an estate asset, and so typically, whether it's a testamentary trust or not doesn't really matter. It's who the ultimate beneficiary is for the super death tax as well. So I hope that helps. Stuart says, any suggestions on how to ascertain the cost base of inherited shares if no documentation can be found? Yeah, that's a really tricky one, and I have had that come up a few times in the past. If you really can't find the documentation and they were purchased a really long time ago, then I think that this is one to check with the accountant as well, because I can't remember the actual accounting sort of standards and details that sat with that. But you basically, I think you have your best estimate of the purchase date, and therefore you can extrapolate sort of like a purchase price based on that as well. One more, and I'm just going to move on. The inherited share and property will need to change the name to the receiver. This involves buy and sell costs as normal, or the cost is exampled. I'm not sure I'm 100% following the question exactly as well, but typically you don't pay stamp duty on inheriting a property through a will. Although there can be some exemptions to that depending on how it's actually passed, and so yeah, you want to probably understand that an estate planning lawyer and a tax accountant as well. Let me know if I'm missing something on that question, because I'm not sure who you mean example as well. And then actually, I will just answer this final one because I feel like it's on the same vein. But early inheritance is awash in the media. I want to pass on my assets early for the kids' benefit and to get out of my name. Do you have resources to assist with this as well? Look, I think this is where you'd want to get some good financial advice to understand the tax implications for you, the tax implications for them, and how you can do like asset protection strategies as well to essentially make sure that you're bloodlining those assets as much as possible, protecting them from relationship breakdown, and those sorts of things. It is a bit of a complex area. And the right moves will depend on the dynamics of yourself, the quantum of money, the kid's position, and where they're at as well. But I think honestly, it's probably the simplest way, or it's the way that you can do it with the most amount of control. Because you're there to sort of see the outcomes that you want through as well too. So. Guys, keep those questions coming through. I'm loving seeing so many of them there. I am just a little bit mindful of time, and there's a little bit there to cover, so I am just going to crack on. Look, the next piece that I want to cover is around investing, and actually, one side is inheritance, but the other side is like creating generational wealth. I want to start with a bit of an example, talking about the power of time when it comes to investing. And so, I've got an example here. In this example, I'm using the long-term share market return of 9.8%, and I've got someone that's saving and investing $1,000 every month. So basically, $1,000 a month, 12 months in the year, $12,000 a year. Over the course of 10 years, someone's going to save and invest $120,000. But based on compound interest and the long-term share market return of 9.8%, you'll see that 120 grand will have grown by about 82,000 to about $202,000. Keep that going for another 10-year blocks. You see that after 20 years, you put in 240, the money's net worth 750,000. 360,000 after 30 years, $2.1 million with the growth, and then 480,000 over 40 years and $5.9 million with that growth as well. And so the reason I put this slide in is to say if you're looking to create intergenerational wealth, the sooner you start, the easier it's going to be. You can see in this example, you got only $1,000 every month, which I get is not nothing, but it's also not a huge amount of money. And so most people should be able to do that, or at least work towards being able to do that. Over 40 years, you're investing $480,000, but you've got almost $6 million. But time can work for you and it can work against you as well. And so I've contrasted this, but just saying, what if for the first 10 years you don't invest? Maybe you procrastinate, maybe you're not sure what to do, so you just got your money sitting in a savings account or something like that. And the money's just sitting there. Then you've got, after 10 years, you've essentially got nothing. Then you see that the numbers are essentially the same, but the difference is pretty significant. That basically after 10 years' time, you're 200 grand behind. After 20 years' time, you're $500,000 behind. After 30 years, you're $1.5 million behind. 40 years, $3.8 million behind. And so the sooner you start, the more compounding works against you. But you need to actually get started. And so, that's an example for just $1,000 a month. You can see that it can create a pretty significant amount of wealth for your generation and for future generations as well. To give you another example around investing for your kids, so I've got, how much in saving and investing at different amounts will grow to by age 21, again, just based on the long-term market returns. Basically, for a kid that's just born, saving and investing $5 a day will grow to $125,000 by age 21. $10 a day, $250,000, $20, $500,000, $40, 1.08 million. Now that's just based on the long-term share market return. That's something that you get from a simple old Aussie share index fund. No stock picking, no speculation. Sleep like a baby at night, knowing that your investments are doing what the market is doing. It's just a matter of how much you're putting in and when you want to actually access the money. But the reality is that you have to get started. It's not just going to happen on its own. And so for a lot of people, I find that the fear leads to inaction, leads to missed opportunity, and people just sit there, and it's easy to end up in that position where you've got the 10 years goes past and you've not picked up on all the compounding. And so you need to know as well, I touched on it around the fact that cash does go backwards after inflation. So if you've got money you're intending to pass down to your kids, or you've got money that you might have inherited as well, money is going backwards. But I wanted to give you an example to show how much of a difference it actually makes. So in this example, I've got saving and investing $200 a week. How it would grow in a savings account, $52,000 after 5 years, or an investment account. And you see that after 5 years, it's a pretty small in terms of the difference, 14 grand difference. But after 10 years, you see that the gap gets a little bit bigger. 20 years, a little bit bigger again. In fact, we're talking now after 20 years about $230,000 compared to 640. So a pretty staggering difference. And then 30 years, 360,000 compared to 1.8 mil. It's like $1.5 million difference. 40 years, again, $4.5 million difference. So I suppose that you don't want to leave your cash sitting on the sidelines. And I suppose then the next question is that if you've got money and you're wanting to invest it, what's the best way to actually do that? And so I wanted to share this case study, which talks about 3 different investors and their results, or 3 different approaches to investing money, and specifically the timing of money and their investing results. And so what we've got, I've looked at the stock market all the way from 1985 to 2025, going through the booms and busts of the market. We've got Black Tuesday, the Kuwait War, the dot-com crash, the global financial crisis, COVID crash, which actually now just looks like a tiny little blip here, but it was such a big deal at the time. And then the 2022 bear market as well. Now, what we've looked at is basically 3 different investor types. One of them has the world's worst timing. And so I'm just going to jump back to this slide, that they basically invest right before that every single huge share market crash, and then their money obviously crashes afterwards and recovers. The other person has the world's best timing. So they somehow managed to pick the very bottom of the market in all of these dips. And they've got their money sitting there ready to go. They know the perfect time and they jump in. And then the third investor just invests every single month. And so the amount here is $500 a month, 40-year period, $240,000 to be invested. So talking you through investor one. So that's the investor with the world's worst timing. They put in their $240,000, and that money has grown to $2.1 million. Pretty good result for the unluckiest investor on the whole world, essentially. But look, we can do better than that, right? The investor two is the one where they've got the world's best timing. So they managed to pick the bottom of every market cycle, $3.2 million. And then the third investor, the one that just invests their 500 bucks every single month, rain, hail, or shine, sleeps like a baby at night, doesn't have to muck around, worry about the markets, ends up with the most at 3.5 million bucks. And so, look, the success lessons on this is that, firstly, no one can pick the bottom. So the only way you've got someone that's picked the bottom of every single market downturn is if they've got incredibly lucky. You may get lucky once or twice, but it's just not going to happen at that level. And if you're trying to time the market, it's stressful and it can be pretty risky as well. Similarly, sitting on the sidelines can be quite stressful. And as you can see from these numbers, that actually the consistent approach, it's the easiest by far, and it's also the one that makes the most amount of money. And so if you're thinking about investing, money that you've got sitting there or money that you want to be investing for your kids, whatever, consistency is king or queen every day of the week. And so I'm going to shift gears again and just talk a little bit about tax around investing more specifically, rather than tax on inheritances, because again, there is this is a crucial area if you want to make sure that the money that you've got, or you're trying to create intergenerational wealth, that the money is actually growing, because at the end of the day, the only return that matters on your investments is your after-tax return. It's great to get a good headline number, but if you're seeing half of it go out the door in tax, then it's a lot worse than actually you have a slightly lower number, but you've got it in a tax optimized structure as well. And so investing is really important, but you don't need to own all of your investments. You can own investments yourself, but you can also own it in different tax entities. So a tax entity is basically anything with a tax file number. So it can be a super fund, can be a trust, can be an investment bond, can be an investment company as well. And so if you own assets in your personal name, you pay tax at the personal marginal tax rates. Starts at 0%. Basically, once you get to $190,000 a year, you're paying tax 47 cents in every dollar goes in tax. And if you're trying to create true intergenerational wealth, your investment income is going to need to be at this level alone, really. And so it's highly likely on that investment income that you're going to be paying a substantial amount of tax if you own the assets all in your own name. But you don't have to own them. As I said, that you can own your assets through these different entities. And so you can own assets in your kid's name, and the kids have got slightly different tax rates, where you can own through bonds. You can own through a super fund, and that has a maximum tax rate of 15%, or you can own through a trust and even put a proprietary limited company next to it, allows you to cap your tax at essentially 30% through that. And what that actually means, I've got an example here showing how much tax you would pay on $10,000 of investment income based on a family here. And I got mum, dad, a minor child, an adult child, and then a super fund and a company. You'll see that there can be quite a variation in the tax rates that are payable. And it goes all the way from, we've got a minor child, so minors basically tax like adults, that they would pay 47% tax, or $4,700 on the 10,000, compared to the 18-year-old who pays no tax, or a company that pays tax at $3,000. And so big difference if you think about it. And looking at compounding this over a bigger number, if you've got $100,000 of investment income, if you're paying tax at personal rates, you're going to pay 47,000 in tax. If you can cap your tax at 30%, which you can do through tax entities like trusts, companies, and bonds, you only pay $30,000 in tax, which is a tax saving of $17,000 every single year. And if you've got more income, the tax savings just become more and more. Like, this is 17 grand that you can be reinvesting to grow your money faster. I gave that example to show investing $1,000 a month, which is only 12 grand a year, and that grew to like $4 million over a 30-year period or something. if you're saving this 17,000 or 34,000 or 51,000, that's basically a whole investment strategy on its own. And so this is why the tax structuring of your investments is so important, particularly when it comes to intergenerational wealth as well. So when you're planning your tax on your investments, know that personal is the simplest, it's the cheapest, it's sometimes it's the easiest. And look, for a lot of people, it's a good place to get started. But as you start building up momentum with your money, then this is where entities can become more and more valuable. And trusts can give you a good amount of flexibility around that, because the great thing with the trust is that with trust, the main rule is that it needs to distribute money to other beneficiaries each year, but you can change which beneficiaries you use from year to year based on which beneficiary will give you the best outcome from a tax perspective. I will just say with this though that these are not DIY solutions. You want to make sure you're getting the right advice, that you're aware of all the implications, and that you've got the right assets in the right structures as well, because it will make a big difference to your bottom line. And I see a lot of people, particularly with trust. I love trust. I've got a trust, but I see a lot of people that have trust at the wrong time, and it's like that might have nothing in there, or they have a really small share portfolio, and we ask them, well, why did you set up a trust? And said like things like, well, it's what rich people do, I thought, or my mate had one, or I've heard that it's a good thing to do. Any entity is only good if you're getting more benefit from having the entity than you are in terms of the cost, both in terms of money and in time of you actually managing that entity as well. And so make sure you're getting the right advice, I suppose, is the message there. Now, on kids investing, that I thought this was worth talking about because it's a really common one. And I will just say that there is a blog on the Pivot Wealth website. If you just Google Pivot Wealth, tax on kids investing, you'll find a blog where I dive really deep on this because it is a little bit complex. But basically, if you're investing for your kids and your kids are minors, you've got to choose, who owns the account and how you do it. Basically, you can own the investment in your name, but basically you will pay all the tax in that case. You can own the investments in your kid's name, and then they will pay tax at the top marginal tax rate. But the benefit is that when they own it in their name, in the future, there's no capital gains tax to transfer the assets to them. It will be if they sell. You can also hold the assets through what's called an informal trust, where you pay tax on the income, but essentially under the ATO's rules, there's no capital gains tax on transfer. And so the right move, again, it depends on how much money you've got there, and it also depends on what the money is for. And so, for example, if you know that the kids are definitely going to sell the shares to, buy a property in the future, then you could have it in their name, but you'd be paying top marginal tax rate for the whole time that you had it. Whereas if your tax rate is lower, you can own it in your name, then you sell it in the future, you give them the net proceeds anyway, and they're potentially a little bit better off as well. And so I suppose it's just about understanding those rules and making sure that you're using them to your advantage as well. Guys, I'm going to jump into questions in a second. I'm loving seeing all those questions come through. I look, I appreciate that there is quite a bit there, but there is a huge opportunity when it comes to this stuff, both on the building side as well as on the protect side as well. And as I touched on at the start, systems are so important when it comes to your money. You don't rise to the level of your goals. You fall to the level of your systems. This is a quote, I can't take full credit for it, that it's from James Clear, who wrote the blockbuster bestseller Atomic Habits. He talked about it in the context of high performance, and ultimately for high performers that it's good to have good goals, like for anyone when it comes to their money, but it's not about the goals that you have, it's about the systems that you put behind it. And so you want to make sure that your systems are there to optimize tax, to get your investing, and to minimize any mistakes or like, dead money that's sitting there. There's basically five main drags that hold people back from getting the results they want. Holding too much cash, tax inefficiency, having unused equity and not leveraging it, with risk managed, I mean, investing without confidence, and leakage around the saving side of things. So if you're looking to create true intergenerational wealth, and you can nail down these things, then that goes a really long way to getting the results that you want. So, guys, I'm going to jump into these questions in a second. I just want to bring this home now. I want to share this model talking about getting from where you are to future state when it comes to your money. Now, in the future, essentially everyone is on a spectrum. Some people can be doing really well with their money, other people are doing not so well. And when people think about getting from where they are to future state with their money, they think about it like a straight line, but it's not a straight line because of the compounding impact of time and money. So if you're, when it comes to your wealth, intergenerational wealth, your inheritance stuff, whatever it is that you're working on, if you're not 100% on track to end up exactly where you want to be today, you need to do some things in what we call jump the line. Could be optimize things from a tax perspective, start investing a little more, whatever the case may be. And when you do that, you get on track, and then you just need to take the next step and the next step, which is easier because you're already on the path. But what happens is that the longer you leave it, the more time goes on, that the jumping the line bit becomes more and more painful, and putting yourself in the best position can become impossible. And so it doesn't matter where you want to get to, whether it's for you or for future generations. If you want to get to an investment income of 10 grand a month or 20 grand a month, whatever the number is, you need to save a certain amount today. If you wait a week, a month, 6 months, a year, 6 years, you just need to save more and invest more or take on more risk to end up in exactly the same position. So no matter where you want to get to, the easiest time to do that is right now. And look, guys, I hope you guys have got some great ideas from what we've covered today. Just leave you with this quote from Derek Sivers, which I absolutely love. He says that if information was the answer, we'd all be billionaires with perfect abs, and talks about the fact that the power of an idea is in its implementation. I talk to a lot of people about money, all the time, and people get all excited with all these great ideas, but a lot of them, life gets in the way. They don't do as much as they wanted to, or they could have, or they do just enough so they don't feel guilty about it. But that's not going to get you results. You got to take full action as well. And so, look, guys, I hope you found that helpful. This is our bread and butter as well. And so, if you well, I'll talk about how we help in a sec, but essentially, whether it's with us or anyone else, if you're getting some help with your strategy around inheritances or intergenerational wealth, what that allows you to do is leverage proven frameworks, use the right tactics so you get more progress, avoid mistakes, give you more confidence, allows you to then take more action. And as I was just talking about there, the action drives the results. And so I am just going to pop this into the chat because this is what we help people with sort of every day of the week. We do this quick sort of 10-minute chat where we talk through what the opportunities are for you, give you a bit of Q&A, and help you understand your next steps and how you can take them. If we think there's a fit, we could talk about how. If not, we're more than happy to point you in the right direction, give you some content or some contacts if that's what's needed here as well. And so, yeah, so I'll pop that into the chat there as well. If any issues with that link, just let me know because I did. Oh, yeah, no, that seems to be working. Great. So I'm just going to jump into these questions. Inheriting shares, capital gains tax if they're sold after they're inherited. Look, I'm not sure if you missed the bit at the start, but essentially with inheriting shares, you inherit the cost base. And so you pay capital gains when you sell those shares, so long as the shares were purchased after capital gains tax was introduced in September of 1985. So did I interpret it correctly that a share portfolio I inherited in 2012, record keeping, I would need to know what my father paid for those shares, not when I inherited them? Correct. So if you're inheriting the shares directly, then you're inheriting the cost base. If the shares were sold as part of the estate and then you got past the cash, then the estate would need to manage the tax on that side of things generally is how it works. So yes, you would need to know roughly what the cost base is for that as well. And if you're calculating cost base on shares or any property, make sure that you're factoring any expenses. Try and dig into the records. I appreciate that might be a little bit tricky, but all of, renovations, repairs, advice fees around investments as well can form part of the cost base on those assets, and that can significantly reduce the amount of tax that you pay as well. Appreciate all the comments, guys. I'm just going to stick around and sort of hammer out a couple more questions as well. I do appreciate that probably a bunch of people need to go. So, look, guys, we're going to have more events coming up as well. Check those out. I was just chatting to Prashant and the Sharesight team. We've got a lot of great feedback from you guys, so we will be bringing you some more. You can check on our socials and stuff in the meantime for more as well. Just take a couple more. I have retired with no income, hence don't qualify for a loan. Is it advisable to buy an investment property with cash outright? What else can I invest in with 600 grand? Look, I can't give you advice on that, and it does really go back to your strategy. But one thing I would say is that generally the return on shares and property, if you take debt out of the equation, is quite similar. What makes the difference is around the leverage, because when you buy a property, you're typically borrowing money from the bank, and you're amplifying your returns that way. And so I wouldn't be particularly, for me personally, I wouldn't be hugely stressed about it because the return is quite similar. And so, if you're not buying property, then you could buy shares, and then you don't have to jump through any hoops with the banks or anything like that as well. He says, what type of trust do you use? I have a discretionary trust. But the reason that I have it, well, the reason that I set it up initially is because I own my business through a trust, and that gives me flexibility on that side of things as well. Carry forward losses of the deceased estate do not transfer to the estate, so use them up. Yeah, that's a good point. I don't know if there's a question there as well, but maybe that's just a warning to say that carry forward losses from the deceased do not transfer to the estate. So you want to use them up if you do have, particularly if you've got significant carry forward losses. Make sure you get the gains while the person's around, so that you can take advantage of those. Question here, you see accountant, lawyer, financial planner, all of the above. How do you ensure it's collaborative and effective? Well, you get someone to direct traffic, and typically that is the advisor, because they're going to be most familiar with the wealth considerations around that as well. I have seen it work other ways as well. It really just depends, but typically you absolutely need an accountant to do the tax side of things. You typically will need a lawyer to do the financial side of things. You don't need a financial planner. That's where the real money is made, or saved, or whatever the mistakes are saved as well. So I hope that helps. Guys, look, really appreciate all the questions. Look, another great session. Do check out our upcoming events on Eventbrite. You can subscribe through that page as well, and you'll get notified when they do come up. Cheers, team. Bye for now.